Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, July 6th, 2026 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we keep your money invested in the areas we feel offer the best prospects for growth instead of trying to time the market. We focus exclusively on the traditional investments of stocks, bonds, and cash, so we'll analyze fluctuations in the stock market and in interest rates to help drive our overall investment decision process. We'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. And for the 2-week period, the holiday shortened 2-week period, we saw a small decline of about 0.23%. We did see the best quarterly performance in the market from April through June of 2026 was the best quarter since we were coming out of the COVID pandemic in 2020. And so far, we have a year-to-date gain of 9.32%. Next, we'll look at interest rates as measured by U.S. Treasury bonds. We look at interest rates because we believe that they are the preeminent measure of investment risk. Rates are factored into every investment calculation, including stock valuations. Generally speaking, declining interest rates may lead to lower costs of doing business and thus higher earnings for companies, which should help drive stock prices higher. Conversely, increasing interest rates may lead to higher costs of doing business and lower earnings, which would potentially lower stock prices. So thus, we typically say that higher interest rates will lead to lower stock prices and lower interest rates lead to higher stock prices. We also look at high yield corporate bond spreads because that can give us a glimpse into the probability of default for those companies issuing debt to finance their operations. We didn't see a whole lot of change. Let me just modify this quickly. Over the last 2 weeks. So we've got interest rates listed over here on the left-hand side. We've got maturity lengths listed on the bottom from 1 month all the way out to 30 years. And so each dot is an interest rate for a corresponding maturity length. The green line is where we ended the holiday shortened 2-week period, and the brown line is where we were 2 weeks ago. So really very, very small changes over the last 2 weeks. Since this is kind of a mid-year market update, I wanted to pull up where we were 1 quarter ago and 1 year ago. So green line is still where we were at the close of business on Thursday, July 2nd. This brown line is now what we were 3 months ago, and this dotted green line is where we were 1 year ago. It's very interesting to us to see these long-term rates still relatively close together. I mean, we're talking about an eighth of a point difference from the 10-year all the way out to the 30-year. So not a lot of movement on the long end. There has been some movement here in the midterm rate portion, I guess, of the yield curve, and a lot of movement on the short end. We had rates significantly higher a year ago here in the 4.25 range, and now they're down around 3.75. So we've seen a decline, a significant decline in these short-term rates, and not a lot of movement in other places. So it's interesting to us. We have, again, the overall theme for 2026 has been some higher interest rates for most of these maturity lengths, suggesting that investors are demanding higher returns for holding on to these debt instruments. If we go out, well, okay, first, I just wanted to touch on a 10-year U.S. Treasury is kind of the, I don't know if we want to say gold standard, but this is the one that we typically will look at as far as how things are going in the interest rate market. And 10-year Treasury is very correlated to mortgage interest rates as well. So if the 10-year Treasury is moving up or down, we will see corresponding movements in mortgage rates as well. We did see an increase over the last couple weeks on that 10-year rate. We're at almost about 4.5%. I did want to put a little bit of perspective on some of these things because we can always get caught up in the and the recency bias of information. But if we look at the 10-year treasury over the last 35 years, right, coming out of that high inflation period in the 70s and 80s, with declining interest rates, and obviously we're higher than we were back in the post financial crisis and post COVID era. But we had a 10-year treasury between 4.5%, 5%, leading up to the great financial crisis. We had interest rates even higher than that coming out of the period of high inflation we had in the 70s and 80s. So on average, over the last 35 years, our 10-year treasury is just over 4%. So yes, we are a little bit higher than average for the last 35 years, but you could also argue that for the 2010s, these rates were artificially low, and so maybe we're at kind of an average neutral rate. I guess by and large, what I'm trying to say is it's not out of it's not unusual, it's not abnormal interest rates. I think it's actually probably a good, neutral, fair rate of interest for taking on the risk of investing in debt securities. If we look at the spread, so this is the high yield corporate bond spread. This is the extra interest that corporations will be paying for debt that they issue above and beyond what the U.S. Treasury will pay. We did see a little bit of a spike at the beginning of the 2-week period. It's come back down, so we're still at pretty low levels, which suggests to us that there's a pretty low probability of these companies going bankrupt or defaulting on their debt. If we could do the same comparison for the last 35 years, we have the dot-com bubble back here in the early 2000s. We've got the great financial crisis back in the 2008, 2009 area. We had the COVID, and this is where we are now. So historically speaking, very, very low, very narrow credit spreads, again, suggesting that by and large, the corporations here in the United States are healthy, and they are not expected to default on the debt that they're issuing to investors. Even the tariff tantrum that we had a year ago with all the tariff issues that left people wondering if we were going to be able to pay the debts that we had issued, still didn't even come close to some of these prior episodes. As far as the outlook for interest rates, we've got a new Federal Reserve Chairman, Kevin Warsh, who came out in his first press conference a little bit hawkish and made it seem like he was going to be raising interest rates. We don't hold that opinion. We think that the market is pricing in an increase of interest rates over the next 6 months or so. Right now, the federal funds rate is at a 3.75%. This is looking at future meetings for the Federal Reserve over the next year, and whether or not the probability is that they're going to increase the rate at the next meeting. So we've got about an 84% probability that they'll increase it by 0.25% in October, and essentially 100% probability that they'll increase the rate by 0.25% by their meeting in December. We think that there are a lot of factors that we may get into later that we don't think that they're going to raise interest rates. I mean, we could be wrong. Things could change, but as it stands right now, our base case is either that they're going to hold them steady or that they'll actually cut rates between now and the end of the year. I did want to also quickly put into perspective the S&P 500. So we did say that they had the best quarter since 2020, right? Here's COVID, the drop from mid-February to the end of March, right? So when you start from a really low period or a low point to measure quarterly performance, it's really easy to say you had a great quarter. So here at the end of March, because we shut down everything for 2 weeks to slow the spread, and then things finally turned around, at least in the stock market, as we had government assistance and both fiscal and monetary assistance to get us through that. Even with the tariffs, that was announced right here the first week of April. So I guess we ended the quarter a little bit higher, so it wasn't as much of a over outperformance. because we dropped in the first week of April and had to recover from that. But yeah, this the Iran war that started in February. I mean, it was almost the same kind of market activity from end of February to the end of March from the Iran war as we had from February to end of March from COVID, and then just huge rebound. So anyway, that was interesting. As far as what's working, what's not working for the first 6 months of the year, if we take a look at the companies that are not doing so well, a lot of these companies like Intuit, we call software as a service or SaaS as an abbreviation, not doing super fantastic because they are challenged by artificial intelligence and whether or not they're going to stick around or be able to generate the same amount of revenue and profits going forward. So a lot of those technology type names are not doing super well. At the same time, there are a lot of companies that are doing well. I think I counted 16 companies that are up 100% or more in the first half of the year, which is highly unusual. And it's, well, we'll leave it at that. But these are also, for the most part, companies that are positively affected by the artificial intelligence renaissance that we're currently experiencing. Moderna is in there. My understanding is that they had some kind of a vaccine they were working on for the Ebola virus that we had an outbreak over the last several months. So for what that's worth. If we were to take a look at what the weight of these companies is multiplied by that return for the first half of the year, we get a contribution to the total return for the stock market. We can see that Microsoft at a 5% weight is pulling the market down about 1.5%. You can see some other big names that are probably familiar to you because they tend to be the larger companies. As far as what companies are doing well, we have Micron, AMD, Intel, right? A lot more of these artificial intelligence names. It's not the same Magnificent Seven that are leading the market like we had been. Some of them are in here, right? Nvidia's in there, Alphabet's in there, but it's not those 7 companies that we had in 23, 24 that were completely leading the market either up or down from one quarter to the next. We did, by and large, have a good quarter as far as how broad the market has been performing. We had over 300 of the S&P 500 that were positive, and actually the best sector as far as the number of constituents that were positive for the year so far was the energy sector, which, with oil prices having gone up and gas prices, that shouldn't be too hard to understand. But utility companies, the utility sector also took second place for the number of constituents that were positive. So we're not being completely led by artificial intelligence or the Magnificent Seven. This is a very broad-based performance or participation by the stock market as a whole. And I think that's everything I wanted to cover for our year in review. Okay, for our expectations and implications portion, this is really our mid-year outlook. So we're kind of looking at the next 6 to 12 months, where we think we're going to be by the end of the year. Obviously, there's a lot that is going to happen between now and the end of the year. We don't have a crystal ball. We're just making our best guess. We know that there are things like a midterm election coming up. We also know that the U.S., Canada, Mexico trade agreement that President Trump put in place in his first term is coming up for review. And there's a whole host of unknowns that are out there that we can always speculate on, but we assign probabilities of outcomes and we try to position based on where we think we're going to be, and we adjust those as new information comes to light. So not a lot of news for the last 2 weeks. I want to quickly pull up. We've looked at oil and gas prices, which will probably discontinue unless there's something that we feel like we need to discuss. But gas is below $70 a barrel. right? Where oil was right before we started firing missiles at Iran was $67 a barrel. We're at 68. So we're essentially back to where we started prior to the war. Gas prices still have a ways to go, right? We were below $3 a gallon before the war started. We're at 3.82 on average. We have talked about this taking probably until after Labor Day, just because we're in the summer driving season. We have all the gas refiners saying that we have to keep these prices elevated because the gas that we're delivering is from the oil that we were paying over $100 a barrel for, so we need to recover our costs, blah blah blah. Um, so it's on a trajectory. We think we'll be back below $3, sometime in September, maybe October. It just kind of depends on how things go, but we're moving in the right direction. We have also talked a little bit about whether or not interest rates are going to go up or down. Um, and we've shown this chart for the past few weeks where the Federal Reserve sets an interest rate. It's a short-term rate that is kind of a benchmark for the rest of the rates that are paid for different maturity lengths. So the white line is the federal funds rate. The blue line is the 2-year Treasury yield. And then these red bars are recessionary periods that we've had over the past 25 years. So by and large, the 2-year Treasury tends to be highly correlated with the Fed funds rate. And if the 2-year yield is going up, the Federal Reserve will raise rates to try and keep it from going too far too fast, and ultimately try to help push it in a downward trajectory. There are times where we'll allow that gap to extend for a period of time. Again, hoping that we're able to equalize the interest rate before ending up pushing the economy into a recession, although the track record is not very good for the Fed to do that. The difference so far is that they were able to do that here in 23-24. We had all the inflation and interest rate hikes here in 2022 that were painful to endure. But we did raise the Fed funds rate above the 2-year Treasury, and it's been pushing it down for the past several years. Once the war in Iran started, the 2-year went from about 3.5 up to 4 and an eighth, and we've kept that interest rate at the Fed the same since then. And we would anticipate this 2-year yield will come back down below without the Fed needing to raise interest rates. We think that Mr. Warsh at the Fed is going to, we think he's coming out doing somewhat of a Trump negotiation where he's making it seem like he's going to be hawkish and raise interest rates, and ultimately will not. I think we'll be able to have rates come down without the Fed raising their rate, but we also know that he's setting up some task forces to look at other things such as inflation and whether or not the economic data that is coming out is accurate and reliable. So the Trump administration has been very good about sowing a lack of confidence in economic data and whether or not it's actually something that we can make decisions on. So we think between now and the end of the year, we could see some changes to either economic data that is published or that the Federal Reserve is using to guide their interest rate policy. We think that this negotiation between Iran and the United States will endure for, probably the rest of the year. We're hoping that it doesn't end up turning into, a very long, drawn out conflict like Russia and Ukraine has turned into. But we can make a case for either direction. And so, yeah, I mean, we are generally optimistic as far as the stock market's concerned. We think that as investors' expectations for interest rates come down and the rates come down themselves, that will be beneficial for stock prices. We've seen some analysts predicting around 8,000 for the S&P 500, and we're about 7,500 right now as of the close of market on Thursday. We think, our base case would be about 5% higher from where we are now, which puts us around 7,850. So we're not as bullish as others. But yeah, generally speaking, we're expecting volatility around the midterm election. We wouldn't be surprised to see a typical 5% decline either right before or right after, depending on how our expectations go for all of those different congressional races. But yeah, I mean, we're not necessarily taking any major changes to positions. We actually just had we have a one-on-one review of our investments with analysts at Fidelity, just to kind of get some of their best ideas and share what we've been doing for our clients. And they had one change to the investments that we're using. One suggestion for us to change. They thought everything else was looking good, even the percentages that we were using for all the different investments. So we were feeling pretty good about coming out of that. So again, no real change to investment strategy unless there is any individual request. But yeah, we're feeling pretty good about where we are. We're looking forward to third quarter earnings. We think, or sorry, second quarter earnings that will start here in July. We think that there's going to be a lot more optimism coming from the corporate offices of these companies. And now that the Iran war is winding down and we have lower inflation expectations, and we wouldn't be surprised to see higher stock prices in the third quarter. We doubt we'll have a record quarter like we just did, but we think it'll be mostly positive for the third quarter. So that's where we're at, and that's how we're positioned. And if you guys have questions, let us know. We'll end it there. We're not going to skip a final word. This has been long enough. We'll just leave it there. And we're recording this on Friday, July 3rd. We hope everybody had a great 4th of July holiday weekend, and we'll talk to you soon.